Hey everyone, and welcome to another episode of the Adventures of a Real Estate Investor. I'm Susie.
And I'm Michael, and we're excited you joined us for this adventure.
So today's guest is Clay Hepler. Thank you so much for joining us today, Clay.
Absolutely, guys. It's really a pleasure to be on.
Yeah, and we are just so super excited. So could you please share with our listeners your background and why you started investing in real estate?
Absolutely. So my background was I was a failed diplomat. I was working for the embassy in Buenos Aires in Argentina. This would be about, I think, 7 years at this point ago. And I was like driven I wanted to be in the embassy. I spoke Spanish and Portuguese fluently and a little bit of German. And I really wanted to do sort of U.S. Latin American bilateral trade relations and be involved in the State Department. And I ended up like having working for the embassy down there with some NGOs in Buenos Aires. And I was like, this is the worst thing this is horrible. I'm stamping passports for 5 years. This is what my life is going to be. I mean, I was like, and then after that, you have 10 years of doing X or Y. And I'm sure that there's a ton of people that find that incredibly fulfilling in terms of serving the country, really being able to connect with the local country and local communities. But to me, it was like, that was not what I was, maybe my expectations were wrong, but I really didn't like it. So at that point, I was injured. I was a college athlete. And I said, hey, I want to take some time off of school because really my focus in life was I wanted to be an ambassador. And the original steps of doing that, you either buy your way in or you work your way in, right? You're either a millionaire and the president appoints you or multimillionaire, or you work your way in through working through the embassies and different state departments, right? Mm-hmm. So my career path was sort of obliterated in a series of a couple months. So I dropped out of college actually and took some time off and ended up being indefinite. And I joined my family's chocolate company. It's luxury chocolate, sort of all natural chocolate. And actually this weekend or right now when we're recording this, guys, the company is in New York City at the Specialty Food Show and it won 3 of the top awards that a specialty food can win in the world. They call it a Sophie Award. It's like the Oscars of specialty food. So I'm no longer a part of the company, obviously, because I'm not there and we're having a podcast. But really, I learned a lot about business strategy, sort of understanding how business works. And along that same timeline, I met a gentleman that was a successful developer in Washington, D.C. area. He was a multifamily developer as well as a office guy. So he developed office buildings and he also had a pastime he liked specialty food. So he had a couple of specialty food shops. And that's how I met him, sort of through selling our chocolate to his store. And so what happened was, I don't know, his tenacity or ignorance or a little bit of both. I built a relationship with him. And he sort of kind of at arm's length told me, I was like, how did you do this? How do you have all these specialty food stores? And he started telling me about real estate. He started telling me about you have to own equity. Equity is sort of the key to wealth. Cash flow is great and income from a W-2 is great, but really equity converts into making your money work for you when you're not there. So basically equity is sort of this word, this name that we can put towards saying, I'm going to divorce my income, the wealth that I create from my time. And that's one of the things that he really taught me. And he taught me about, hey, you got to own businesses and real estate and think about tax strategies and think about actually creating value and life insurance. And I was like, well, I've been in the family business for a while. I think I'm going to go out and try real estate. So I joined a firm in my city, local city, and did some wholesaling for the firm. We scaled it to 75 deals in our first year, wholesaling and flipping. And all along the way, I'm sort of accumulating knowledge. And I said, hey, I want to jump into real estate. So I did the thing that a lot of real estate investors do. I house hacked a 3-unit building. I still currently live in it. And I leveraged that equity, the appreciation to put a line of credit on my building. Plus, I had a life insurance policies at this time, and I was using them to BRRRR other buildings. So I bought a 3-unit, then I bought a single family home, then I bought a 6-unit. Then I bought a luxury Airbnb, which we talked about. That's an adventure. And then now I have 12 units in escrow, and I just closed on a 3-unit, and we BRRRR everything. Now I'm raised debt, I raise private money, and I raise hard money, and I go out along with my cash and my life insurance policy loans. I go out and buy these properties and refinance them, and that's the strategy. That's my journey, and here we are today.
That's awesome. Would you mind sharing with our listeners 2 things? One, what is a house hack?
Okay, sure.
For people who don't know what that is, and then obviously what is a BRRRR as well.
Sure. House hack is, I think, it'd be hard to argue against being one of the single greatest ways to get into real estate. Essentially, what you do is you leverage the 30-year fixed loan, low down payment loan. You can pay 3.5%, 5% down, 10% down of the total loan balance. And you can buy a house, you can buy a duplex all the way up to a 4-unit and put only 3.5% or 5% down and live in it. Now, when you live in it, what that does is that reduces your overall expenses. For most American, housing is about 30 to 35% of their total monthly expenses. So when you reduce that, what you do is you're essentially saving all of that money. But you're not only, I like to point this out, you're not only saving that money, you're also acknowledging the opportunity cost of paying that money towards rent instead of investing it in real estate. Because now that, or whatever you want to invest in it, now that you have that money that you're saving every month, you can allocate that to buy more real estate. You can allocate that to invest in your education or save more money or do whatever, go on vacations. That's great. And so I say that's one of the single greatest ways to get into real estate. Someone else pays for your living expenses. Number two, you said, was the BRRRR strategy. The BRRRR strategy is rooted in finding a distressed asset, a property that is under market value. Maybe it's 60%, 70%, 50% of market value, but it requires a lot of work to fix up. Maybe there's a roof issues, there's rats infesting the house, which I purchased a house, there's rats everywhere. It's absolutely crazy. I mean, everything. Or maybe it's just a property in which the property owner is actually just wants to get rid of it. I mean, you guys have purchased apartment buildings from people maybe that wanted to get rid of them at a price that was below what you thought the property was worth, which is why you purchased it. When you buy this property, the second R is rehab. What you do is you say, hey, I think this property is going to be worth $500,000 when it's done. I bought it for $250,000. If I put in $100,000, I think I'm going to be able to have that $500,000 so I can go back to the bank and tell the bank, hey, this property is worth $500,000. I want to refinance it, which is the fourth step. I skipped over rent it out. You got to put a renter in there at that point. You rent it out when it's nice, you fix it up. And then after that, you go back to the bank and you say, hey, I'm going to refinance this property, and you can get all your capital out. Plus, in some instances, as you guys both know, you can get more of your capital out. And when you get more of your capital out, it's not like flipping a property. Flipping a property, you have to pay capital gains taxes. A lot of times it's short-term capital gains, which just wallops you with taxes. Instead, because it's debt, it's thought of differently in the eyes of the IRS. So it's actually tax-free. And then the R is repeat. You keep doing it. As real estate investors, it's kind of like an addiction. When you start buying real estate, you just got to feed the addiction and you keep going and going. So that's the BRRRR method in the house hacking.
I love it. Thanks for explaining that. That's a very detailed explanation. So I'm sure our listeners appreciate that for sure.
Absolutely.
So how are you using, because you had mentioned your life insurance, how are you leveraging that with real estate?
Yep. So basically my mentor, guy that ended up being worth, I think like $150 million. I mean, he was an incredibly successful real estate investor. Basically said, hey, there's places that you can put your money. A lot of Americans save their money in a retirement account, right? We're taught that, hey, put your money in a retirement account and save it there. I think it's kind of a hybrid. It's kind of a savings and kind of investment, because essentially when you think about putting your money in a retirement account, it really comes down to until you're 59 and a half, right? You're basically giving up control of your money and hoping that it compounds until you're 59 and a half. Then you have access to it. And then other people, Americans, will either put their money in like a CD or a savings account. Instead of doing that, you can put your money in a life insurance policy. Now, the reason why a lot of wealthy people put their money in a life insurance policy is because there's guarantees. There's guaranteed growth. The way that life insurance policies are set up now, you can have guaranteed 3% tax-free growth. It's guaranteed never to go down. Wealthy people like guarantees, especially if you're a real estate investor and you're going out there and you're buying these BRRRRs, or you're buying apartment buildings like you guys do, or other Airbnbs. You're swinging for the fences. You want to be able to have guarantees in your life. So you can flow your cash into a life insurance policy that's tax-free growth. It compounds over your life and it's creditor and asset protected. And then, very similar to real estate, you can leverage the equity or the cash in your real estate with a line of credit. Now, you can see people do this on many different asset classes. People do this for gold. Very wealthy people do for gold holdings, or some people do it with art or Bitcoin. And if you're a real estate investor, you know that you can do it with a line of credit on your real estate or stocks. Now, all of these assets are great to put on lines of credit because it's tax-free access to this equity built in, but it can go down in value. In 2008, the banks came back and said, if you had outstanding line of credit, they could take that. If the market goes down 20%, you have to coverage. It's called a margin call. It happens in Bitcoin. Bitcoin's like 26,000. I bought it when it was 68,000. I bought a very small amount, and I got my shirt. I just got my claw cleaned by it. That's another reason why. That's another reason why you should invest in what you know. But long story short, the reason why my mentor likes this, a lot of wealthy people like life insurance as a savings vehicle, is because you have all the benefits of the appreciation of the equity through the guarantees and the participations of dividends. Usually the growth is between 4 to 6%, while you can simultaneously access it tax-free in the form of a line of credit. So your money's working for you in two places. So that's why I originally started to put my money in a life insurance policy, because I said, hey, this guy was incredibly smart. He leveraged this. It's a lot less risky than leveraging other assets. And that's wealthy people think about tax savings and leveraging assets, which is called collateral, to enhance and amplify their wealth building journey. So that's why I used it. I mean, it wasn't like I wasn't a genius. He said, hey, Clay, you should do this because I've been doing this. And I researched it a little more and started implementing it and, paying for my house hack and my BRRRRs. And now I actually help people, my firm, I actually help people set up these policies as well.
That's really cool.
Can anyone set one up, or are there any stipulations, or what are the cons, right? Because I'm sure a lot of people are going to be thinking that, what happens? What happens?
Heck yeah. Yeah. So that's a really great question, because, you want to make sure that when you're evaluating anything, just like real estate, you need to know that there are downsides, right? So when it comes to life insurance, there are, number one, it's life insurance, right? So there's a death benefit associated with it. If you set up a life insurance policy, guess what? One day you're going to die, and life insurance contract is going to say, hey, I'm contractually guaranteed to give you a death benefit. What does that mean? Well, nothing in life is free. You got to pay for the death benefit. So what that means is early on in the process, depending on your health, depending on your age, you're going to have to pay for the death benefits, for the commission, to make the life insurance company profitable. So it usually takes between 4 to 6 years for your premium deposits to go in for you to break even, because you have to pay for the cost of insurance. So what a lot of people come to me, guys, that are interested in terms of setting up one of these policies, they say, well, I love it. It sounds awesome. A lot of wealthy people do this, but waiting a couple of years for me to for my money to break even, I don't know about that. Mm-hmm. And the way that I always say this, and I say that's a really, really good point. But if you're a real estate investor, you know that when you're investing the first couple of years, could take 4 or 5 years for you to start to be profitable. Because what happens if your roof breaks? What happens if, I speak from personal experience, what happens if your HVAC breaks, right? And so it takes a while for your well. Sometimes well, yeah, right. Right. Sometimes well, yeah, right. No, but that's a great point. I mean, I don't know. It sounds like someone that might have that experience, but long story short, it takes a while for any successful business endeavor, for any successful real estate investment to really start to turn profitability. And we see the same thing in life insurance, right? This is not a get rich quick thing. It's not the magic bullet. It's just an alternative place for you to store your capital that is going to be over decades. It's going to be the most efficient and effective place to store your capital. But if you want to make a lot of money, there's a lot of people on YouTube that are selling, trading, and crypto mining and all that stuff. You should probably ask them, because they know how to make money faster than I do.
Absolutely. What are your thoughts on infinite banking, the whole infinite banking thing? I've heard people take it to extreme with life insurance policies, where they even pay for their groceries with their policy and things like that. They never even use a bank account. They use their insurance policy. What is your thoughts on that?
Right. So that's That is a really, really good question. And, we're all as real estate professionals and professionals in general, we're constantly learning and thinking through and putting together new theses about how we operate in our, one year we might think this way about real estate investing, one year we might think differently. But as it stands now, I think that that's a little bit far-fetched. And here's why I think that. I think that it's a little bit far-fetched because what happens is if you put all of your money into a life insurance policy like this and you flow everything through it, it starts to say, okay, I'm starting these new policies. I might have a couple of policies and I'm using the early stages of these policies to pay for my groceries or to pay for, my clothes.
Yeah.
I think that kind of defeats the purpose of this. There is an opportunity cost for you to use your money to pay for your groceries. I mean, and using a loan from a life insurance company, I don't think that's what it's designed to do. The way that I speak with my clients about this is that I say, this is your savings vehicle that you're going to allocate and direct towards expansion. Now, if you want to have a defensive financial strategy, then maybe keep some extra money to pay for your groceries or to pay for your clothes or vacations or stuff like this. I think that it does make sense in terms of paying for cars. There's a couple of examples, larger capital purchases in which it does make sense. But for smaller stuff, I think that that's where it gets a little extreme. And that's where I get lost. I'm like, I don't know if it's it's not like the all-encompassing economic strategy. I think you need to have some liquidity and cash reserves.
Yeah.
How do you guys, what's your opinions about that?
Yeah, absolutely. I mean, I think the same way. I think it becomes very, like you said, the opportunity cost, right? Because now you have to deal with taking out this money in your insurance policy to buy simple things like grocery, gas, things like that, like things that you need to just live, right? When then all that time it's going to take you to do all that, you lose all that opportunity cost. No, I mean, I think it's important to have something set up like this where it's like a savings account, because my savings account, like I have very little money because we're always investing, but like whatever saving, because we just keep putting money out as it comes in, but like whether we get like 0.5% or whatever, right, which doesn't even outpace inflation or anything like that, but like having that money that I would typically have in a savings account into like a life insurance policy would be better for sure, in order to like hedge inflation and things like that. So
yeah, and this is the way I would analogize it. Every single person who is setting up a policy like this, it's like a different trainer, right? A physical trainer will go into the gym with you, and they'll have how they view the world, and they'll project that onto you. If you go to the gym with a bodybuilder and you just want to get functionally fit, I don't know if that's going to be the best decision. They're going to ask you to eat, so much protein, and you're going to have to overeat, and you're going to have to work out in it a different way. The way that I look at this is for real estate investors who want to amplify their savings, and you can put together more and more and more policies like this to effectively create legacy planning. But there is a point at which it gets a little bit overwhelming. It's just like eating a good diet. You can do keto. Keto is kind of restrictive though. Why don't you just eat whole foods, great fruit, and eat a good diet overall, and you're going to be very successful. And that's the posture that I have towards my clients. Don't stuff everything in here. It's not like the strategy that's going to outpace your real estate investment, but it is a really, really good place to store your savings.
Yeah. And it's not just for the active investor, it's also for the passive investor, right? Because like, even when it comes to like bigger syndications, or depending on like what a JV entails, right? Like you could use it for a joint venture, because if somebody is even like the main, I guess, partner on that one, and you're just helping bring in funds, like there's a variety of different ways, even how you mentioned with single family homes, with short-term rentals. Like you don't just have to think about it like one dimensionally, like, oh, I'm not going to do a flip anytime soon, so I don't need it then. Like, no, that's not the point. Like you can use it for all of the different areas. And that's really, that's where it makes it, I guess, a better opportunity for a variety of different people.
Mm-hmm.
In addition, you can set up these policies in terms of buy-sell agreements. So if you have a couple of partners that are syndicators, like you said, and and you have a bunch of assets, millions and millions of dollars of assets, I've seen very successful syndicators set up agreements so that if one of them gets disabled or if one of them passes away, that they have this life insurance policy that'll be able to pay off, the other syndicator so that they can effectively be relieved of their duties, and the husband who might not be the syndicator or the wife who might not be the syndicator essentially gets that from the partnership. And so there's really, really interesting ways for you to set up tax efficient banks in these businesses that can pay you a death benefit and get you out of the businesses too.
Yeah, because especially with real estate, right? Like a lot of the best parts are all the tax benefits. So like when you can leverage two things to make those benefits even greater, it's a big difference.
Absolutely. Absolutely.
And I just want to add one more thing quickly before we go to the final 4 questions we got for you. I think, and correct me if I'm wrong, so self-directed IRA is obviously a vehicle where you can store money for retirement and things like that. But then you can also direct that, into various different investments and stuff like that. However, there's limitations with a self-directed IRA in that you can't invest in your own real estate. While a life insurance policy allows you to invest kind of in basically whatever you want to invest in. There's no limitations to that. And another benefit of it versus a self-directed IRA is that you don't have that UBIT tax. So when you have leverage on real estate or whatever, then whatever leverage you have percentage wise, if someone wants to look up UBIT tax, it's UBIT. They can Google it. I'm not going to talk about it here, but basically there's a tax that the IRS says because you took leverage, then we're going to tax you on top of that or whatever. So it minimizes your returns, but that does not exist, if I'm correct, with a life insurance policy.
Exactly. I mean, you can just think about it. If for most of your listeners who are real estate investors, you can just think about it as, hey, I have equity in my life insurance policy, just like I have equity in my real estate. I'm going to leverage it like a line of credit, just like a home equity line of credit, except the only difference with the line of credit for life insurance is you define the payment terms. So you can define, hey, if you have a year of low liquidity, you can defer it off in the future and not have to pay it for a couple of years. So that's another really great flexibility benefit of this, and why real estate investors, you're like, should I pay this off or should I get another deal? Should I pay this? I'm going to buy another deal. That's what a lot of real estate investors are opt in for. So, yep.
Absolutely. Cool. Well, it's been such a pleasure, Clayton, chatting about, everything about your experience in real estate, but also how people can leverage the power really of life insurance policies. Let's transition now into the Adventurous 4. These are 4 exploratory questions we ask all of our guests. So Clayton, if you're ready, we have 4 questions for you. Number 1 is, where is one place you wish to travel to and why?
Oh, I wish to travel to. I want to go to Switzerland. I've never been to Switzerland. I am, as you guys know, I have a place out in Colorado. My significant other is from Colorado. I absolutely love Colorado. I love the mountains, but I've never been to Switzerland. I find outdoors in the mountains just absolutely breathtaking and moving. And so I really want to go to Switzerland because the food, because the beauty, the architecture, the rivers look like Jolly Ranchers, and the mountains are so, the difference between elevation, the sea elevation related to the mountains make them very, very impressive, even though they're not as high as the Rockies. The way that the mountains are actually formed in Switzerland, the Alps, are just absolutely gorgeous. So that's where I want to go.
I love it. I do. So the second question is, what is one thing on your bucket list and how are you leveraging real estate investing to achieve it?
Ooh, I have a couple of things on my bucket list. I guess what I really want to do is I want to live 6 months abroad.
Love it.
Sort of I speak, as I referenced earlier, Spanish and Portuguese fluently. So I love Spanish speaking countries. I actually met my wife in Spain. So I have a very strong affinity for Spain, but I'd like to travel around Europe for 6 months. And I think I'll probably be able to do it next year, because I'll be able to, I believe, have the finances to do that and really be able to leverage my business and still be able to serve my clients and have my real estate business sort of run on autopilot. So I would say that's a big bucket list item.
That's cool.
Awesome. Cool. Yeah. So the third question is, what is one piece of advice for someone who wants to start passively investing in real estate?
Oh, yes. And that's a really great way to get started. The one piece of advice I would say is, in a sea of a lot of investors that are promoting themselves and their products. Obviously, you really want to look into track record, but you're in a marriage with someone, even if you're a passive investor, and you want to really make sure that your values, the way that the person interacts with the world and who they are at their core, that is aligned with who you are. Because not every real estate investment is sunshine and rainbows. A lot of them has been going well because of just the appreciation, inflation of assets. But there could be a time in which the property doesn't go to as well as it could or is projected to go. And you want to make sure that the person with whom you're working is a person of integrity. That's very important. So,
yeah, that's great advice. Thank you for that. Then our fourth and final question is, if you had unlimited resources available to you, how would you leave an impact?
Well, I think I would first start in my inner circle. I would first start with my family, my wife's family, as well as my family. I really, really care about them and love them. And one of the reasons why, one of my big whys is actually helping them retire. Even though my mother and my father, primarily my mother, have this business. You guys know how businesses are. It's been incredibly successful, but she's got to sell it, right? In order to really retire. And one of my dreams is within the next year or two to take her, because she loves Lucca, Italy, to take her to Lucca. And then to take care of my wife's family as well on a really deliberate vacation to show them how much I love them. And also just sort of provide them with an appreciation for what they did in my life. And then outside of the context of my family, I think that financial education is incredibly important because it's a very significant point of stress in our lives. I mean, if you look at the statistics of in America in general, one of the largest reasons why relationships actually fall apart is not because of a lack of sex, not because of a lack of love. It's really because of issues with finances. And issues with finances, I think, can be solved. And so what I'm doing with my company now is I'm really trying to serve the real estate investors and the entrepreneurs, which is a segment of the population that might be able to impact through the way that they sort of interact with the world. If they're incredibly impressive entrepreneurs, if they're really trying to change the world, or real estate investors who are creating sanctuaries for people, that helping those people get more financially solvent so that they can impact the world. Yeah. And also go to Mars. No, I'm just kidding.
I think you guys need to buy a ticket soon, right?
Right. Not
right. Elon Musk, yeah. Awesome.
Well, before we end the show, would you please share with our adventurous family the best way that they can get in touch with you?
Totally. Yeah. So you can get me on my website, creative-capitalist.com. Right there, it's pretty straightforward website. You can check out a webinar about all the stuff that I talked about today. And also you can reach me at clay@creative-capitalist, or I'm a friendly person. You can text me at 412-552-3029.
Cool. And thank you so much for that. I will make sure that all of those are included in the show notes so that all of our listeners can find it easily. But thank you so much, Clay, for joining us today. Like, you are so valuable, and I really appreciate you just taking the time to share all of your value with our listeners.
Thank you. It was a pleasure. I really appreciate people's time, and I'm hopeful that this podcast really left an impact in at least one person's life.
Yes, it will.
Yeah. Awesome. So until next time, explore more, adventure awaits.
Woo!